Okay, let's talk about issuing stock. Why would a company want to issue stock? They choose to issue stock because they want cash or capital. In other words, they may want to expand their business or they have a need for cash. So they can issue stock, which gives away ownership to the investors. And in exchange for that ownership, they receive cash. And it's cash that they don't have to repay. So when we issue stock, we make a journal entry to show that we have cash and we gave away some of our ownership. And this is called paid in capital because it's capital that we got from our investors. Okay, so let's look at our new accounts. Common stock is a capital account, and capital accounts have a normal credit balance. Now let's look at how to calculate. And it's going to be the number of shares times par. Preferred stock is also another class of stock, and it's a capital account, and it also has a credit balance. And we're going to calculate it the same way, the number of shares times par. Paid in capital in excess of par is also a capital account, and it also has a credit balance. The paid in capital account is whatever amount you got in excess of the number of shares times par. So we could just say amount exceeding par. Or let's say amount exceeding above. If you got more money than the number of shares times par, this would go into the paid in capital in excess of par. Alright, here's some additional information here. And on March 1st, we issued 220,000 shares of common stock at par for cash. Okay, this is common stock. We're issuing 220,000 shares, and the par value is the same as the amount of cash we got. So par is the same as cash, so we don't have any excess, so we don't have to worry about paid in capital here. Okay, if we get cash, cash goes up and assets go up with the debit. Okay, so debit cash, and we got we issued 220,000 shares at par, and par is $10. So we're going to just say 220,000 times 10. Okay, so we issued stock at par, so we're going to credit common stock for that amount. And that's all we have to do because we issued it and received par value of cash, so there's no paid in capital in excess of par on this one. Let's look at the next one. Okay, for this one, instead of getting cash, we're going to get assets, land, buildings, and equipment. It works the same, but instead of debiting cash, we're going to debit these assets. So I've entered the date, March 31st, and we received land, buildings, and equipment, so I debit these accounts. And you're going to record it at the fair market value, $150,000, $560,000, and $165,000. So we issued 70,000 shares of common stock, so we're going to debit common stock, and remember, you calculate common stock by the number of shares times par, and here par is $10, so we're going to do 70,000 times 10. The balancing entry here is going to be paid in capital in excess of par for the excess. Okay, so I've received assets with a total, if I sum the number of assets I have, this is the amount of assets received. And then we can see that the par value is $700,000. So let's look at the amount of excess of par. The amount of excess in par is $175,000. So we need to enter $175,000 in our journal entry. And you'll see this a lot. Instead of writing out paid in capital, you'll just see PIC, which is PIC. Now, the debits and credits should balance. So let's see if they do. Let's sum all of our debits up, and then let's sum our credits. And so now you can see that our journal entry balances. So that's how you issue stock over par value. And instead of getting cash here, we got assets. Okay, the last one, we issued 18,000 shares of preferred stock at $110 for cash. Okay, the date is March 31st. We're receiving cash because we issued 18,000 at $110. Okay, when we issue preferred stock, we're going to credit preferred stock, and it's always going to be for the number of shares times par. So we had 18,000 shares, and the par value is let's go up here. It says 2% $100 par, so we're going to do par of 100, and there is our preferred stock. Now we can see that we got more cash than what the par value is. And so that amount goes into paid in capital in excess of par, and it's just the amount of cash over the par value. And what I always say is make sure when you're doing a journal entry that your debits equal your credits. So this is how you issue stock. Now there is such thing as no par stock, and with this you just won't use par.
So your journal entry would just be cash and the credit to stock. There would be no paid in capital in excess of par because you don't have par.
Let me know if you have any questions.